Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Costs are a crucial part of the equation. It doesn't take a genius to know that the bigger the profit of the management company, the smaller the profit that investors get.
Think your money manager has your best interest at heart? Well, let's find out.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, Tony Walker.
If you got it, you don't need it. If you need it, you don't got it. You don't get it, shame on you. Funny, funny, funny what money can do. Them that have it get more of it. The less they need it, the more they love it. And it sticks to them like glue. Funny, funny, funny what money can do.
In my 35 plus years in this financial business, there have been very, very few people in this business who have had a profound effect on my thinking and philosophy about money. And for sure, one of those key figures and influencers in my life was the late, great founder of the Vanguard Group, John Bogle. Mr. Bogle, who died this past January, was 89 years of age and considered by many to be the father of what's known as the indexed fund, more specifically what is referred to as the S&P 500 index fund. Now, one of my favorite financial books to read is simply called John Bogle on Investing, The First 50 Years. It's a book I would highly recommend you read because what it deals with is the issue of what we'll be talking about on today's show, cost, C-O-S-T-S, cost, because it is plural, and there are many of them. And in fact, one of John Bogle's greatest quotes, he was asked once about, what do you consider before investing? And Mr. Bogle simply responded, it all depends. Well, welcome, folks, to the Worry-Free Retirement, and I am Tony Walker, and for the next 28 minutes or so, we're going to be sharing with you this whole notion of costs and why the financial world doesn't want to talk about them. And if you're just now joining us, we've been in our series of the Pyramid of Misdirection, which deals with things that the financial world would rather take our attention off, which is how to make more money on our money and risk less of it. And in this case, more cost and why we shouldn't worry about these costs. But of course, in order to explore this very interesting topic of how to save you a bunch of money, with me in the studio on this beautiful July 23rd, 2019, in our Lowell studios, is America's favorite financial sidekick, Mr. Aaron Orander. How you doing, Aaron?
Good morning, sir. I'm doing great. How about yourself?
I'm doing well. How's that remodeling coming at the house?
Oh my gosh, we took a break this weekend. My father-in-law and I just needed a little bit of a break. We're getting walls up. We're getting bathroom installed. We're plugging ahead. But I sent him a text Thursday night, and I was like, "Why don't we take a break this weekend?" And he was like, "Yeah, it sounds like a good idea."
And well, it's good to hear. I'm glad you're getting your house all fixed up and spiffied up. And with you over there, already preparing for the TV show, our technical assistant, Megan Murphy. And by the way, folks, we do have a great TV show. It is also called The Worry-Free Retirement. And some of you say, well, I can't find the show or I can't watch it. You know, one thing you can do is just go on the internet, go onto YouTube. We have a YouTube channel, Tony Walker Financial. Is that right, Aaron?
That's right. They just type in Tony Walker Financial in YouTube and it'll come right up.
Watch past episodes of the show. Really, really good stuff. In fact, as you will, I was going to say see today, as you will hear today, today's topic is going to get a little technical. It's important what we cover, but on the TV show, we'll be able to show some of the numbers and graphics I'm going to be talking about. So I highly encourage you to either watch the TV show. You can check out the listings at TonyWalkerFinancial.com. If you can't watch it or DVR it or find those listings, we have people all over the country listening to the radio show as we watch our Google Analytics. Sounds like I know what I'm talking about, don't I, Aaron?
Yeah, you sound smart.
Okay, good. I think this digital stuff is fascinating to me. Thankfully, I've got a lot of creative people around me that understand digital, but all I know is we can find out a lot of times where people are. Well, you're not going to get the TV station in, Nova Scotia or something, but you can watch, again, the shows on YouTube, so I encourage you to do that. All right. So here we are. There's basically 4 costs, okay? So now we're at more costs. Well, what are those costs? Well, the 4 key costs that will erode your money, folks, and it'll erode it in a hurry, Here they are. Basically, there are taxes on your money. Most of you have no clue what you're paying in taxes. You have no clue what's going to be taxed in terms of your 401k. I call that the tax tumor because it's hidden and the darn thing just keeps growing and you don't know how to deal with it. We do, so we can help there. Fees, that's today's topic. We're going to focus mainly on fees. We'll focus a little bit on taxes, but since we're talking about the late, great John Bogle, who knew how devastating fees were, that's why he came up with an index fund. That's another eroding factor to your money. Insurance premiums. I'm a big fan of insurance companies. You know, annuities are written by insurance companies. I own a ton of whole life insurance on myself. I was able to buy this building in Louisville, borrowing from my own policy. I love whole life, but there does come a cost with all this stuff. And then finally, interest we pay to others. So those are the four costs: taxes, fees, insurance premiums, and interest paid to others. But again, while we will focus on taxes and insurance premiums a little bit, we really want to focus on fees. So here's my first question, all right? Whether you have a brokerage statement, a 401k, my question has to be, do you know what the fees are on that account? And we could wait a few seconds and I know the answer. Most of you'd say, I have no idea what I'm being charged. In fact, it was interesting. Now, this was following the crash of 2008. 60 Minutes did a wonderful story on this and just really exposed the fact that not only did all these savers have money at risk, and many of them lost their life savings and had to go back to work, a pity the thought there, but many of them had no idea how the fees were being charged. So let me play a quick break. It's only a few seconds long, but look at how 60 Minutes gets a quote from somebody that understands how fees are charged on 401ks. Listen to the array of fees charged on these particular 401k plans.
There are legal fees, trustee fees, transactional fees, stewardship fees, bookkeeping fees, finder's fees, and the list goes on and on.
Okay, so where did all these fees get started anyway? I always hearken back to 1978. Three key things happened in 1978. My granddad retired after 43 years with Bell South. I graduated high school. Nobody really cares about that, but that was important to me. And then finally, the biggest, the 401k, was enacted into law. Now, what does this have to do with fees? Well, before 1978, and you can check out the facts, folks, most people were not in the stock market. My granddad had zero stock. Have you ever talked to your grandparents about money? Did any of them invest in stocks? One of them had some Duracell, didn't they?
They had a little bit. Well, actually, it was Energizer. Yeah, okay, they had a little bit of stock.
Did they have a money manager?
No.
Okay, this is where we're going with this, Aaron. Yeah, so back in those days, people that were somewhat savvy usually went to a stockbroker. And a lot of them were located literally on the corner. In our town of Bowling Green, on the corner there sits a stock brokerage firm. That thing's been there forever. People used to go down and look at what they'd call the ticker tape, and they'd sit with their stockbroker. Stockbrokers made commissions, which to me made perfect sense. I think commissions are actually a good thing because you know what the commissions are and it's fully disclosed as long as you've got an ethical advisor. But what happened was stockbrokers had to work for that money. They had to constantly be on the alert. They had to find good buys. If you bought a stock from a stockbroker and paid a commission and it went down, you could hold them accountable, and say, hey, come on now, what's going on here? So in a way, the old business of people having knowledge of stocks, looking at individual stocks that they believed in, like Aaron's grandmother who liked Duracell stock. Many people I run into, Aaron, now that are older folks that have quite a bit of money, sometimes I'll ask them, I'll say, how'd you come up with all this money? A lot of times they bought one stock and one stock only, and they just poured money into that stock over and over and over, and pretty soon they had a lot of money, okay? We have a company, one of the largest ESOPs in the country is located in Bowling Green, Kentucky, Houchins Industries, and we've seen this. I'll have people that come to me from Houchins. These people have been there for years, working in the checkout line, and they're worth all this money because really their money, theoretically, was all in Houchins, and they were a member of the ESOP, same concept. But what happened was when Wall Street entered Main Street through the 401k, they began to introduce something called mutual funds. Mutual funds. And thus the money management business began, and fees, not commissions. And you've been led to believe that fees are a good thing. Fees, folks, if they're not reasonable, everybody has to charge a fee. We have a Schwab platform where we charge fees. We charge a whopping 0.6%. But what we're going to see here in a minute, the average money manager, the average mutual fund, folks, is charging you out the wazoo, and why this is such a devastating effect on your retirement. When we come back, we're going to take a deep dive And by the time I'm done with this, you're either going to thank me and want to meet, or you're going to probably lose your cookies over this when you see how much fees Wall Street is making on your money. You're listening to The Worry-Free Retirement. I'll be right back. Have you recently retired, been laid off, or offered a buyout? Has the company you work for recently moved or been acquired or closed its doors forever? Then take advantage of this opportunity to move your 401k to safer territory. Why continue to risk your hard-earned money when you don't have to? Let's meet in person today to discuss your retirement options. Log on to TonyWalkerFinancial.com to schedule your no-obligation appointment to meet with me in person. Do it today. Welcome back to the Worry-Free Retirement. If you're just now joining us, we're getting ready to understand why Wall Street went from commissions to fees and why Wall Street loves fees, folks. Think about this business model, Aaron. Let's say you and I open a financial store of sorts. Let's say people really don't know much about money. And we either have to go out and work and find new money every day. Every day we get up, we got to go out and find money. And for every $100 we find to deposit in our financial store, we get $1. Not bad, right?
That's okay.
But we got to work hard, don't we?
Right.
We got to keep going out and finding these $100. We got to fight, scrimp, advertise to get $1. And after a while, you look at me and you say, Tony, this is a lot of hard work. What if we did this? What if we didn't charge people $1, but we could figure out how to keep the money here forever and only charge them 10 cents, but do it per year where they'd really never notice it?
Okay.
Okay, at first we wouldn't make a lot of money, right? Because we were used to making $1. But if we could keep the $100 there, we wouldn't have to work as hard, because guess what? Next year we'd get another 10 cents for doing nothing, basically.
Okay.
You with me? In 10 years, we'd have $1. After 10 years, we're past our break even. If we keep them happy and just keep the money there, we get 10 cents every year in perpetuity. You ever watch Shark Tank?
Yeah.
You ever notice Mr. Wonderful, he always wants royalties? You ever notice? Well, he's smart. He knows that, and he always says in perpetuity. So in some ways, folks, you've got Mr. Wonderful there, the money manager, charging 1.5%, 2.5%, whatever these fees are. We'll look at this in a minute. And they get those fees whether you make money or not. We've talked about, I saw a recent ad where this firm, big firm, they say we do better when you do better. Folks, what they don't tell you is they do better regardless of how you do. They're going to make all these fees, so you have to understand the fees. Oh, this was a great article, Aaron. This was written by Noah Smith. I'd like to talk to Noah. He's a pretty sharp fellow. And this came out of Bloomberg.com recently. I love the title. Listen, why money managers are paid so much is a mystery. The byline says there might be lots of reasons, but market-beating performance isn't one of them. See, folks, this is what John Bogle, we're talking about John Bogle, what he said years ago. He knew intuitively that you cannot outperform the stock market over the long term. You can pick all these stocks all you want, but by the time you charge all these darn fees, you're dragging down the return.
What happens in the fund business is the magic of compound returns is overwhelmed by the tyranny of compounding costs. It's a mathematical fact. There's no getting around it. The fact that we don't look at it, too bad for us.
Does this make sense, Aaron? Yeah, if I like to use the example of headwinds. If I fly out west in an airplane, I'm going to go faster because I have a tailwind. That is just a fact. If I turn around and fly back in that same jet, going the same miles per hour, the headwinds are against me. I'm going to go slower. It's going to take me longer to get back east than it does go west. So the point is, folks, why in the world would you want to pay 1.5% to 2%? And that's what this guy's talking about. He says, why are they paid so much, and what exactly are they doing? When in essence, the facts prove this out, in essence, if you compare the long-term performance of the vast majority of money managers, almost all of them, they have not been able to beat the S&P 500 or the indexed fund. So what am I saying? Am I saying run out there and get index funds? That's not necessarily what I'm saying. I'm just saying, folks, you have to count the cost. Now, here's the thing. Back to this example of getting money and holding on to it and charging fees. Back to 401ks when they started in 1978. Very little mutual funds out there. Very little money managers charging all these fees. Listen to this, Aaron. It is estimated today between mutual funds and money managers and ETFs, all that stuff, there's now $20 trillion being managed. Remember the 10 cents?
That's a lot of 10 cents. That's a lot of dimes.
There you go. Yeah, that's like the taxes. The politician once said, hey, $1 billion here, $1 billion there. Pretty soon that adds up to a lot of money. Yeah. 10 cents here, 10 cents there. So here's the point, folks. You've got all this money in your 401k. You've been led to believe to max it out. You can't even touch that money until you retire. This really sounds like a great deal to me. You have no use of it, no flexibility. If you've got it in the market, you're taking all this risk. You have no written game plan on how to use it, how to deal with all these costs. And in the meantime, somebody makes 1.5% on all this money, all these years, and they didn't do anything to earn it. That's what this gentleman said. What are they doing to make all this money? Okay? Now again, if they're adding value to what you're doing, like we charge 0.6%. We oversee the accounts personally. We have great service. You can meet with me in person. I have another fiduciary on staff, Heather, that's available to answer your questions. We do all the liquidations. We do all the payments to your checking account. We estimate all the withholdings. We provide Social Security analysis at no charge. We do tax planning for retirement accounts, no charge. All these things are value added. So you have to ask yourself, if you're going to pay 1.5% to 2%, what are you getting for your money? A great quote from John Bogle to summarize this. He basically says, why try finding the needle in the haystack when you can just buy the whole haystack? Does that make sense, Aaron?
Yeah.
Yeah, so he's saying, why would you just buy the S&P 500, which is very low cost, and that's where most of the return is anyway? Why are you trying to find this magic bullet? Remember, we talked about magic on one of the previous shows. So here's what we're going to do. We got a great question when we come out of the break here from Rick in Louisville about him trying to figure out what in the world he's being charged. And we did an analysis on his fees for this gentleman. This is some good stuff coming up. You're listening to the Worry-Free Retirement.
Are you retired or retiring soon? Can you afford for your money to take a hit with the stock market being so volatile these days? Nobody can time the market, but having a retirement game plan with Tony Walker Financial gives you peace of mind and sleep insurance. Learn how to prevent losses in your retirement accounts and plan your retirement around an income you can never outlive. Log on to TonyWalkerFinancial.com today to schedule a personal meeting with Tony to secure your hard-earned money. That's TonyWalkerFinancial.com.
And now it's time for Tony in the Trenches.
Okay, our question comes from Rick out of Louisville. He says, Tony, I continue to get reams of paperwork each quarter from my stockbroker who handled my 401k rollover. So basically, Rick apparently years ago rolls his 401k over to a stockbroker. Again, it's a money manager, let's call it that. And he's saying, I cannot figure out what the fees are, and he will never really share them. This comes up a lot, Aaron. People come in, and it's funny how when you get to costs and fees, people conveniently change the subject. I had somebody come in the other day that had been to a dinner seminar. They were talking to a prospective advisor, which is fine, and they showed their accounts, and they had it all laid out in this real pretty picture. And I said, by the way, what are they charging? And they said, well, I asked them that, and they said, well, we have very low fees. And I said, well, no, it's not what
really
I asked.
an answer.
Yeah, that's not a good answer. Low fees as compared to what? Somebody charging 4%? Folks, first and foremost, listen to me closely. You have every right, and if somebody's worth their weight in gold, they will tell you two things. As a fiduciary, I'll tell you this, I'll put it in writing. Number one, if they work with commission products, which we do, they will share with you the commissions they're going to earn. They should be glad to do that. We will do that for you. Number two, they should share exactly what the fees are. Not only, listen closely, not only what the advisor is going to charge, but the investments underlying the investments they're going to select. Folks, there's usually two tiers here, and most people miss this. So what we did, and again, if you're just now joining us and you want to watch this particular show on TV where we cover these graphics, good stuff, you just want to log on to YouTube, type in Tony Walker Financial. That's our YouTube channel. And this episode, you can call it up and watch it again. And again, this is some good stuff here, folks. Aaron, by the way, our TV shows, do they run about like the radio shows, or are they like a week behind?
No, they're usually the radio show will run like on a Thursday,
Okay.
and that the TV show that correlates with it will run that Sunday. So we'll usually have it up within a couple of days after the radio show.
And by the way, over in Lexington, WLAP, that's on Sunday,
That's right.
the radio show, but we're also in Lexington on WLEX TVs on Sunday morning.
That's
So just, yeah, but if you missed those, again, go to the YouTube channel. But so what happened? This gentleman gave us the sheet. This was all these statements, okay? I mean, it was reams of them. So I gave them over to Heather. Again, she's the other fiduciary. Heather's job is to analyze the fees. So she comes back with our report. All right, first of all, he thought the money manager was charging 1% per year. Well, that's not what they were. When we calculated the fee, the money manager, remember folks, remember the dime story. Every year gets a dime, dime, dime. In this case, every year gets 14 cents, 1.4%. All right, that was just the money manager's fee. So this was an account that was worth about $126,000 and thereabouts. Every year, the money manager takes 1.4%. Now, here's where the rubber meets the road. There was a total of 1, 2, 3, 4, 5, 6, 7, around 12 funds, Aaron, that this person had. Diversified, that's great. But when you average it out, the average mutual fund fee, this is in addition to the advisor's fee, was almost 0.7%. So now we're all of a sudden at 2.02%. Mm-hmm. Okay. Now this is whether the money grows or not, Aaron. They're gonna ding this thing every year. So right there, you're almost talking about $2,600 per year. So what Bogle is saying is, listen closely, folks, you've got to make $2,600 before you even can get back to break even, because that's their fee. Is this making sense, Aaron?
For doing what?
That's the question. That's a great question, and that's what the article is talking about. Now, again, I'm not saying rush out and cancel all of your money with your money manager. That money manager may be providing some wonderful services, and you may be very happy with that money manager. You like them, you trust them, you're happy with the accounts. I'm not telling you not to pay the 2%. Okay, let me be clear on this. I would never judge anybody for charging 2%. What I'm judging is, what are you getting for the 2%? Is there any guarantees? Is there any other services? Is there any planning going on? Or is this money manager just shuffling around stuff and then when it goes down just tells you to hang in there? Well, folks, anybody, I could train you to do that, Aaron. Money managers, a lot of times, even they're not even picking them. What a lot of the money managers are doing are actually going out and hiring money managers. So now we have another layer of cost. So folks, if you want to sit down with a fiduciary, that would be me in person, or talk to me by phone, and just look at the whole gamut. Let's just take a look at everything here. How are you going to save money on fees? We can do that for you, because here's the facts. While I can't guarantee you I can earn more than your money manager, nobody can make that claim. I'm not going to make that claim. They could make boatloads of money and you could care less about the 2%. What I can guarantee you is, in 99% of the cases I've run into, we can save you money in fees. That is a guarantee. So if I save you in fees, you're going to have more money in your pocket, meaning actually more to invest. Is this making sense, Aaron? And this is called opportunity cost. So when I come back, I'm going to diagnose one of the goofiest strategies ever that in a perfect world works perfectly, but in the real world is semi-disastrous to your money. This is something called buy term life and invest the difference. You're listening to The Worry Free Retirement. Let's dive into cost in just a second.
Tired of the financial world chasing after your money? Dinner, seminar invitations, annoying pop-up ads on your computer from out-of-state advisors? It all adds up to confusion. There is a better way. Meet in person with nationally recognized retirement specialist Tony Walker. Tony's personal one-on-one approach has helped thousands of savers worry less about money, and best of all, Tony's right in our own backyard. Don't leave your retirement to chance. Make the short drive to meet in person with Tony now. To get started, simply log on to TonyWalkerFinancial.com.
Have you recently retired, been laid off, or offered a buyout? Has the company you work for recently moved or been acquired or closed its doors forever? Then take advantage of this opportunity to move your 401k to safer territory. Why continue to risk your hard-earned money when you don't have to? Let's meet in person today to discuss your retirement options. Log on to TonyWalkerFinancial.com to schedule your no-obligation appointment to meet with me in person. Do it today. Welcome back to the Worry Free Retirement, folks. By the way, we've got a brand new website, and something we did, the gentleman that programmed our website suggested this, and I love this. When you go to TonyWalkerFinancial.com, okay, you're going to see kind of in the middle of the screen called a search bar. What we want you to do is go on there and just type in what you're thinking about. If you're wanting to download something, if you want to learn more about annuities, if you want to look at our Schwab platform, whatever it is, you can type that, and we would like people to go on there and type right now what you're thinking about so we can gather more and more data in terms of what to put in that search bar, okay? So please go to that if you have any questions, if you'd like to meet, if you have questions about anything, TonyWalkerFinancial.com, click on that search bar and type in your request. Oh, by the way, you know, one thing I want to share, and Aaron, you saw yesterday was Monday. We're recording this early Tuesday morning. Did you notice how busy I was yesterday?
Oh, you were slammed.
It was crazy.
You had one break and it got filled up.
That's right. Yeah, thanks for reminding me.
Yeah.
But folks, I've told you this before, I love working hard. I love what God has allowed me to do, to have the ability after the last 35 years to have such a passion of helping savers. So Mondays is my busiest day, but the reason I'm sharing this, and I'm not being braggadocious, people say, well, Tony, do you really meet with people? How can you see all these people? Yesterday, and I've got the sheet right here, Aaron. This is my appointment sheet from yesterday. Now, keep in mind, busy day. I started at 11, ended at 9 p.m. I saw 19 people. Many were clients. Many were first appointments, second appointments, people that wanted to do business. Here's the point, folks. I'm going to see you through retirement. I'm not going to just write an annuity or write some business and then all of a sudden you don't know where I disappeared to. That's not what an ethical retirement specialist is supposed to be. The point is, this is not a one-shot deal. Once you work with Tony Walker Financial, Lord willing, and assuming he's going to keep me healthy, I'm here. I'm going to be here to serve you. I have plenty of staff. We're adding 2 more staff members. My job is to have better and better staff to service your needs as our clientele grows. It's not to add 400 advisors and Tony disappears into the wakes of the 19th hole at the golf course. That's not what this is all about. So again, if you'd like to sit down with a trusted advisor, 35 years plus of experience, log on to TonyWalkerFinancial.com. Click on that Let's Get Started. All right, speaking of Let's Get Started, Aaron says, chop, chop, Tony. All right, real quickly. Buy term and invest the difference. What we've done is we've imagined somebody invested $10,000 a year for 30 years between the ages, let's just say 35 and 65. They put it away. Let's say they even made 10%. What people don't realize is you have taxes. Maybe they decide to buy some term life insurance. You got to pay for the term life insurance. By the way, you know why term life is so cheap, don't you, Aaron? What does insurance companies know? If you're 35 buying $1 million in term life and it's only $1,000 a year.
Well, they're hoping I'm going to live a lot longer.
Well, they probably know you are, right? Yeah. They got all the statistics. So, folks, term life is cheap. Sometimes it has its place, but it is one of the most costly insurances you can buy, and I can prove that. Then you have the fees at 1.5%. You have the taxes. You have the capital gains. You have the dividends. So in a perfect world, in 30 years at 10% at $10,000 a year, you should have about $1.8 million. I ran some numbers on this, and this again will be on our television show. The software we have took into account what's called opportunity cost. All these taxes and fees, insurance premiums, folks, that is a drain on your money because not only do you lose the dollar, you have to pay somebody else, you lose the interest the dollar could have earned. And if we're assuming you made 10%, which I would never assume that in the real world, but that's what the guy on the radio keeps talking about. But if you made 10%, that means we're going to have to put an opportunity cost on 10% of all these losses. So what that means is in the real world, not having 1.8, but by the time you deduct the taxes, the fees, the capital gains, the opportunity cost, and the term life insurance, instead of having 1.8 million, you ready? Drum roll.
I'm ready.
You'd have about $830,000. So the net effect of this, folks, in the real world, about $1 million is gone. Now, where did it go? It was cost. So, folks, here's the thing. If you're sitting there saying, but Tony, I don't have anybody talking to me this way. They're not helping me understand cost. All they do is talk about how they're going to grow my money. Hang in there. Don't worry about it. Everything will be fine. Well, that is not a game plan for anything, folks. What we do is provide free written game plans. And more importantly, if you become a client of Tony Walker Financial, we disclose all our fees. We disclose our commissions, full transparency. And best of all, you have me overseeing the plan for the rest of your retirement. That's what this is all about, is servicing your needs through retirement, not just when you retire. So give us an opportunity. It's absolutely free to talk. There's no obligation. Just go to TonyWalkerFinancial.com. Either type in the search bar your questions or click down to the Let's Get Started button, and we can make that happen real soon. Well, we hope you've enjoyed today's show, The Worry-Free Retirement. Next week, we'll be talking about our pyramid of misdirection, more fear. Between now and then, you remember, if all else fails, you be worry-free.
If you got it, you don't need it. If you need it, you don't got it. You don't get it, shame on you. Funny, funny, funny what money can do.